Your brain is about to explode with knowledge. Here are 26 financial terms explained as simply and as quickly as possible. Balance sheets are just financial statements that total up all debts and all assets. Balance sheets function with a simple equation. Assets equals liabilities plus equity. Liquidity is the principle of how quickly an asset can be converted into cash. Cash is the most liquid asset, usually followed by stocks. The least liquid assets are land and real estate because it can take weeks, months, or even years to sell. GAAP, no, not the store, but generally accepted accounting principles, are rules and conventions that govern how a company reports the state of their finances. It's essentially just a standard, and companies can report their earnings as GAAP or non-GAAP. Capital gains are just the increase in value of an asset above what you paid for it. Capital gains can be realized and unrealized. Unrealized gains mean the asset hasn't been sold, and realized means it has. You pay taxes on realized capital gains. Capital losses are the same, but when the asset is worth less than you paid. Net income is just total revenue minus expenses. Equity is just the amount of money someone has in a stock or asset after subtracting off debts and money owed. It's possible to have negative equity like in a car or house if you owe more than the asset is worth. Often, a cause of negative equity is depreciation, which is a simple decrease in an asset's value over time. Most physical assets depreciate over time, with real estate being the usual caveat to this rule. EPS, or earnings per share, is the usual way in which a company's profitability is represented. It's simply net income minus dividends divided by the number of shares. Usually, share prices for a stock end up being some higher multiple of EPS. Net worth is just the value of everything you own minus what you owe. Amortization is just the process of accounting for an asset that is intangible or non-physical in a way that spreads it out over time. This usually applies to assets like patents, copyrights, or trademarks. Capital markets are simply markets where buyers and sellers trade financial assets like stocks or bonds. Companies, institutions, mutual funds, and hedge funds are the usual participants in these markets. Profit margin is just net income divided by revenue. This gives companies an indicator of how much wiggle room they have to continue turning a profit. EBITDA, or earnings before interest, taxes, depreciation, and amortization, is a term commonly used to describe a company's cash flow. FICO score is just a credit score from Fair Isaac Corp., the company that invented credit scoring. The score ranges from 300 to 850 and is based on payment history, length of credit, and total amount owed, though no one knows the exact formula. In the public, stock options are the option or the right to buy a company's stock at a given price. These are generally given to employees and can be hugely valuable if a company's stock goes up after being granted an option at a lower price. Bonds are essentially just a loan from the purchaser of the bond to the seller of the bond. Government bonds are just notes for loans between the buyer and the government. Over time, the government pays it back, but before then, you can also sell the bond to other investors. Stocks are just shares or portions of a private or public company that can be traded or sold. Stocks have value based on a company's earnings, potential earnings, and other factors. Cash and cash equivalents refers to assets that are either cash or can be converted to cash easily. Here go, they're liquid. An income statement is just a financial statement summarizes how much income and expenses a company incurred in a given time, often called a profit and loss statement. ROI, or return on investment, is a calculation that indicates how much money was made from an investment. It's calculated as the income minus the cost, divided by the cost, times 100. In this sense, it's expressed as a ratio. Cash flow is simply the net balance of cash that is going in and out of a company. It can be segmented into operating, investing, and financing cash flow based on where the money comes from. Compound interest is essentially just interest on interest over time. After earning interest on an investment, that interest payment starts earning its own interest, compounding over time, getting larger and larger. Valuation is just the worth of an asset or a company. Generally, It's calculated with varying formulas incorporating income, EBITDA, revenue, cash flow, and other financial figures. Liabilities are anti-assets, or just debts owed. Liabilities can also present themselves as wages to employees or payments due to suppliers. Working capital is the difference between assets and liabilities, or the cash available on hand for daily operations. Finally, term life insurance is an insurance policy that covers a set period of time. If you die in that term, your beneficiaries receive money, and if you don't die, then the policy expires with no value. So let's talk about amortization. Make the background music inspiring and finance-related. Now moving on to capital markets. Settings, let's dive into the intricacies. Finally, let's discuss profit margins. Use a male voice for the narrator. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's a measure of a company's overall financial performance and is used as an alternative to net income in some circumstances. Your FICO score is a 3-digit number based on the information in your credit reports. It helps lenders determine how likely you are to repay a loan. The higher the score, the better your creditworthiness. Stock options give employees the right to buy company stock at a fixed price for a certain period of time. They can be a valuable part of a compensation package, providing potential for future financial gain. Bonds, quite simply, are loans made by investors to borrowers. Typically, these borrowers are corporations or governments. When you purchase a bond, you are, in essence, lending money to the issuer in exchange for regular interest payments and the return of the bond's face value when it matures. Use the best audio available. Government bonds are debt securities issued by a government to support government spending and obligations. These bonds are considered low-risk investments because they are backed by the full faith and credit of the issuing government. They often serve as a safe haven for investors during times of market volatility. Stocks, on the other hand, represent ownership in a company. When you buy a stock, you become a shareholder and own a piece of that company. Stocks have the potential for higher returns compared to bonds, but they also come with higher risk. The value of stocks can fluctuate widely based on the company's performance and broader market conditions. All right, so let's dive into cash and cash equivalents. These are the most liquid assets on the balance sheet. They include physical money, demand deposits, and other short-term investments that can be quickly converted into cash. Moving on, we have the income statement. This financial report shows a company's revenue and expenses over a specific period. It provides a clear picture of the company's profitability and operational efficiency. Lastly, let's talk about ROI, or return on investment. This metric is crucial for evaluating the efficiency of an investment. Essentially, it measures the gain or loss generated relative to the amount of money invested. It's a key indicator for making informed financial decisions. All right, so let's talk about cash flow. It's the lifeblood of any business. Without positive cash flow, even the most profitable companies can struggle. Essentially, cash flow is the net amount of cash being transferred into and out of a business. It's crucial for covering day-to-day operations, paying employees, and investing in growth. Now, moving on to compound interest. This is where things get really interesting. Compound interest is, well, the interest on a loan or deposit calculated based on both the initial principal and the accumulated interest from previous periods. It's often referred to as interest on interest and can, over time, make a significant impact on your investments or debts. Understanding how compound interest works is key to making smart financial decisions. Valuation is the process of determining the current worth of an asset or a company. It's crucial for making informed investment decisions. There are several methods to determine valuation, including discounted cash flow analysis, comparable company analysis, and precedent transactions. Each method has its own strengths and weaknesses, depending on the context and the specific details of the asset or company in question. Liabilities represent the financial obligations of a company or individual. They include things like loans, accounts payable, and mortgages. Understanding liabilities is essential for assessing the financial health of any entity. High levels of liabilities can indicate potential financial distress, while manageable levels can show a company is effectively using leverage to grow. Working capital is the difference between a company's current assets and current liabilities. It's a measure of a company's short-term financial health and its efficiency in managing its operations. Positive working capital indicates that a company can fund its day-to-day operations and invest in future activities, while negative working capital can be a red flag for potential liquidity issues. Term life insurance provides coverage for a specific period or term and pays a benefit if the insured person passes away during that term. It's a straightforward and affordable way to ensure financial security for your loved ones. Unlike whole life insurance, term life does not have a cash value component, making it a more cost-effective option for many families.